One question which people have been asking me is why are the markets booming? Should we invest in large cap or mid and small cap? Look, I don't have all the answers, but I can make a intelligent guess. So let me start from the US, because it is the US money which creates inflation or rising markets all over the place. So in the US there is no choice, because if you are an US based investor and your interest rates are very low, even if you take risk in the US, you will not get more than 1.5 to 2%, because the Fed has just flooded the market with money. So there is no great choice in US. So you come down, you say, okay, let me go to Europe. So Germany, which is the best, gives you negative rate of interest. So no chance of being in Germany. So that money has to come to India. What we would think is because the markets there are not doing well, or because the markets are overpriced, or whatever be the reason, they don't want to invest there, so that money is likely to come to India. We also call it TINA. There is no alternative. Now, what happens to the Indian investor? Well, the Indian investor, even if he's a senior citizen, he looks at the bank rate and he says 5.5% is what I'll get. Why should I keep it in bank deposits? And I have no clue whether interest rates will go further down in India, and if it does go, how long it will go, and where will it stabilize. Either you assume it is stabilized now, or you assume it will go up another maybe 100 basis points, it will go down, and there it will stabilize. Somewhere you have to assume that it will stabilize. So Indians are not too keen. But having said that, look at the bank deposits. They're still surging. People are keeping money in bank deposits. But apart from that, the money will come back, will have to be invested somewhere. Now, what happens in real estate is there seems to be some problem. But I do feel that 5-6 years real estate, especially in cities like Mumbai and all, have not really moved up at all. So which means that could be the turn. We don't know. Rates are available at about 7% tax free, which I think is an amazing interest rate. There is a recent there's a IPO coming. I'm not putting my money, I have not done an evaluation, but I heard those are right. So given the fact that people don't want to commit to long-term loans, real estate markets may not boom too much, because people are not very certain about the jobs which they have. So given that, people don't want to commit to any real estate, so they don't like the yields that they are getting on bank deposits and government securities, right? So having done all that, they have to look at equities, and they feel equity has got value in some pockets, which is true. Even the US market may have some value outside the 4-5 scripts which have just hijacked the market, right? You know those names, Facebook, Alphabet, Netflix, right, the FANG. Now, what that money, the US money could be coming into India. Indians are again contributing to this. SIP is something which is coming automatically. I don't see SIP figures having fallen. I do not know whether the SIP figures have gone down, but the thing is, maybe the SIP figures are coming, but somebody else is withdrawing. The net accretion to equity may not be very high. We will have to wait for a couple of months and to see that. So that all that is happening, but still people are coming into the direct mode. The number of accounts opened at ICICI Securities and Zerodha is mind-boggling. We have no clue. We don't have the numbers coming from, say, HDFC Securities or Kotak Securities and all. But I believe India Infoline is also booming. So, given the fact that so many people want to come directly, there perhaps some more money coming into equities from there. The question is, we do not know how much lower interest rates in US can go, or it has already hit the bottom. In India, again, we do not know what will happen. US credit spreads are also not there, which means there is no risk reward ratio at all. You're not being rewarded for taking the risk. The best way to look at how good a investment in bond is look at the current yield. So he may have issued it to you at an yield of say 9%, but today if the yield is 13%, it is not something to be happy. It just means the market is discounting it so badly that if you have to sell it, you will sell it at a discount. That's all. 13% is not something to get excited. Maybe they can't, maybe they will struggle to pay the interest and the principal. We do not know, but that is the best way to judge a portfolio. Obviously, higher the yields, less liquid the portfolio will be. So, how is it going to impact you? Well, in US, they are already talking about the 3% withdrawal rate. Those of you who know the American markets know that in US it used to be a world famous number called the 4% rule. If you are a retired person with 60% in equity and 40% in debt, for the rest of your life you could withdraw 4% per year without having to worry. That was the theory. They are now talking of maybe that percentage has come down to 3%. I do not know what is the yield number to look at in India, but I have always felt the best to look at is the 10-year yield. So if the 10-year yield in India is, let's say, 6%, it is slightly under that. It's at 6%, you should be in a 50-50 portfolio, be able to withdraw 6%. And I'm not talking about taxation, because on an SWP basis, maybe you will pay 10% tax. So you should be able to withdraw money at about 6%. So has it fallen in India? No. Will it fall in India? Yes, if interest rates fall further and you have a greater amount of money kept in debt instruments, right? The worst thing you can do during such times is chasing higher yields, because the higher yielding portfolios or the higher yielding bonds behave like small and mid cap stocks. Yes, there could be potential, but when it comes to a crunch, you will not be able to sell it, right? So don't chase yields today, especially if you think that you might want a premature encashment of that. So if you get some bond which is at 10% yield, it's not a bad bet at all. Don't chase the 13% and 14%. If your State Bank of India is going to give you money 8%, then chasing 13 may make sense. But when State Bank of India is giving you less than 6, it's giving about 5.5. Don't chase anything beyond 8 or 9. The risk is too much. So don't chase yields unless you're very confident that you will wait for maturity and you know the management, right? So then it's a different thing. The worry in the US market and in the Indian market is the concentration in the market at the top. The 5 shares which we spoke about, the FANG in US, and to a great extent in India it is Reliance, which is now 14% of the Sensex. These are the worries, because some parts of the market are definitely overvalued, which means some parts are not overvalued. So there is an opportunity available to you, and you may be able to exploit those opportunities. Obviously, if something is available at a PE of 60 or 70 or 100, and something is available at a PE of 7 or 8 or even 4, and with dividend yields which is more than the GSEC yield, it makes no sense for you to stick into the higher price things. Time for you to reshuffle your portfolio. So is this a good time to be buying or selling? Boss, it's a time when you should be doing both. Something of yours which is overpriced should be sold. Something which you think is cheap and inexpensive, that is something which you should be buying, right? So everywhere there are opportunities available in the market. There are outside the country, there are good yield portfolios available, but you have to have the ability to invest in them, either through your existing mutual funds who are looking for opportunities abroad, or by going and putting the money outside the country, right? So both those possibilities exist. China looks expensive because the information flow from China is not very good. If you see the videos which come out of China, there seems to be some internal problems. So China may be an avoidable market. In the US, outside the broader market may have place, but the top looks pretty tight and pretty overpriced. But I don't know, I could be completely wrong, because concentration is happening. So there could be both theories, but I don't know. What about gold? Gold has already had a good run up. We do not know how much more it will go up, because gold does well when there is uncertainty. if the coronavirus problem is solved, will gold come down? Possibility is there, I don't know. So buying more gold may not make too much sense. However, if you have an SIP which was running like many people have, then don't touch it because gold could go up. Should you buy more gold? The jury is still out, I really don't know. Even if you take whether in India or in US, it is obviously value which is underperforming and growth which is outperforming. It may not be a great time to be ditching value, good time to be putting some money in value and some money in growth. Chances are growth might outperform for some more time, but remember, value catches up very fast. So suddenly one day value will catch up. So beware of that. The other problems are, this is whatever I've said now till now is the facts. But let us look at what is happening in the US and in India. Rising unemployment, common to both the places. Loss of income, yes. The US is giving out $600 a month to its people. Indian government cannot afford to give, so that's out, right? So that could be one reason driving the US market, the $600. In India, that money is not there, so that is not happening. But along with the unemployment, what happens with unemployment, it is not just the money loss. Suddenly a family which was dependent on the company's medical insurance finds that it is not insured. So you lost your job, and if there is a COVID attack and 3-4 of you are impacted, that is going to be disaster. So the minute you lose your job, see what all you can do to conserve your cash. If you have stopped your SIP or paused your SIP because you had a cash flow crunch, and then suddenly you realize that you don't have a cash flow crunch, start your SIP. However, if you have a cash flow crunch, remember your priorities should be medical insurance and term insurance. The other things don't really matter, correct? So we don't know why the markets are up, but the markets are going up. So it's a time when you should play it by the ear. If you get trading opportunities, take it. Cash is never harmful. Keep booking profits. I can tell you that's what I am doing. I buy a good share, then I find that it's worth selling it immediately because the price has gone up very quickly. I just get out. I don't think too much about long term and all that. So if you are a financial advisor, make sure that you sit with your client, talk to him, prioritize on what he should be doing. Obviously, sit with him means you are on a Geo Meet or a Zoom call. So sit and find out, talk to him, how he wants to spend his time, how he wants to spend his money. Does he have adequate? If he has adequate money, then don't bother about changing anything. And if you think you need to change because he has got a loss of job, check out how you want to do it. Thank you.